Okay. Good morning, everyone, and happy independence to every one of you. You're welcome to another class on covering the ICAN syllabus. And today, we are going to be looking at IES 8 on investment in associates. Before I proceed, I need to be certain that you can hear me clearly. I need any one of you to confirm that you can.
Sir, we can hear you, sir. Good morning, sir.
Good morning. Okay, great. So I will not take your time. I will just go straight to the point and learn what we have to learn today. Remember that for the past 2 weeks, we have been looking at investments, subsidiaries. Our focus has been on investment in subsidiary. And for investment in subsidiary, we have basically focused on consolidation method, how to consolidate the financial statement of the parent and that of the subsidiary. And we've been doing that strictly in compliance with IFRS 10 on consolidated financial statements and IFRS 3 on business combination. Those two standards has actually guided our paths on those consolidation procedures we have been following. And for statement of financial position, the principle is quite straightforward because all we are doing there is just combining the individual items of the parent and the subsidiary into one, while ensuring that all transactions between the parent and the subsidiary is cancelled out. And the popular item that is typically cancelled out is the transaction that actually gave birth to the consolidation itself, which is the investment in the subsidiary. That we usually cancel it out with the equity of the subsidiary. And when we do that cancellation, we discover that there are instances where the parents will pay above the fair value of the identifiable asset and liabilities of the subsidiary, which I've always called equity. When those situations arise, we have goodwill. And we have also looked at scenarios where this goodwill can be impaired. And also, those cancellations as well resulted in making workings for consolidated retained earnings, because in the retained earnings of the parents and also the retained earnings of the subsidiary, to be specific, I was referring to the retained earnings of the subsidiary that you will find in the statement of financial position, we would have cancelled out the pre-acquisition retained earnings. So we will need to remove it when we are consolidating, so that whatever is left in that retained earnings, we call it post-acquisition retained earnings, which will now be shared between the parents and the subsidiary. So we usually, as I said, and the subsidiary and the non-controlling interest. And that we usually demonstrate with that workings I usually do on consolidated retained earnings and non-controlling interest. And again, I was teaching some of you last week, and we were wasting or spending a lot of time understanding non-controlling interest when we're doing when we're doing that cancellation to get goodwill. Like you're trying to understand why is NCI done this way or that way, and I made you understand that NCI that we usually put in that our computation, that cancellation that we do, is just there, just is in and out. Is in and out. The only situation where it will not be in and out is where NCI is measured at fair value. That's the only scenario where you will also have a share of the goodwill. Otherwise, it's in and out. Don't let that one dissuade our focus. So that part of group account is very straightforward and easy. Today, we are going to be moving a little forward so that we can make progress. We're going to be looking at investment in associates. An investment in associates, if you remember, I told you that this arises where an investor acquires equity interest in an investee, and its holding in the investee is between 20% but less than 50%. And I told you that this investment usually gives the investor significant influence over the investee. And if you remember, this significant influence is the power to participate in the financial and operating policy decision of that investee. And this power is either arising either as a result of voting rights, holding between 20% but less than 50%, or if you can demonstrate that he is represented on the board of directors, or there are material transactions between him and that investee, or there is exchange of managerial personnel, key managerial personnel. All these can also demonstrate that the investor has significant influence over the investee. Now, the focus today is accounting for investment in associates. So when an investor has an investment in associates, it will account for the investment in the consolidated financial statements using what we call equity method. Additionally, the investor will also recognize the investment in its separate financial statements, either at costs or in line with IFRS 9. So we're going to look at the two where an investor has investment in associates. So we're going to look at how he incorporates it, how we account for that investment in his consolidated financial statement using equity method, and also how the investor will recognize the investment in its separate accounts, either at cost or in line with IFRS 9. Before we apply this method, I need to mention to you that the same thing we learn in IFRS 10 also applies to IFRS 8, IAS 8, IAS 28 for exemption. Exemption from equity method in the consolidated financial statement. That where an investor might not include or might not apply equity method or might not prepare consolidated financial statement. If you remember, I gave you like 4 or 5 situations. Number one, I told you that where the parent is a wholly owned subsidiary or a partly owned subsidiary. Which means that his own parents will prepare the consolidated financial statement. Or where the parent is not listed on a stock exchange, is exempted from preparing consolidated financial statements, so the equity method will not fly, or its shares are not even in the process of being listed, is exempted from preparing consolidated financial statement. Also, if you remember, we mentioned potential voting rights. If you remember, it's also mentioned here too in IAS 28 that the investor must consider instruments like warrants, options, or convertible debts when determining whether it has significant influence. So before you know whether you have significant influence, you must also consider potential voting rights. Just like we learned when I started group accounts, all those are applicable here. Also, exclusion of an associate from consolidated financial statements. An investor must not exclude a subsidiary from consolidated financial statements unless it has lost control of the associate. I mean associate here. Not control, significant influence. Also is uniform accounting policies, the parents and the associates must have uniform accounting policies before the associates can be included in the consolidated financial statement. Also is uniform reporting dates. Parents and the associates must have uniform reporting dates. Where this is not applicable or where this is not practicable, the parents can include the associates if the difference in reporting dates is not more than 3 months. However, adjustments must be made for significant transactions that occur within those periods. All of these, you have had them before. I just intentionally went over it. Now, let's concentrate on why we are here, which is the separate first in the separate financial statement of the parent. How will the parent account for investment in the associates? Like I mentioned, the first thing when you buy an investment is that the investor or the parent must include that investment in its financial statements, either at costs or using the principles in IFRS 9. And if you remember, in IFRS 9, when you buy investments in equity, it's either you measure it at fair value through profit or loss or fair value through OCI. And with this one, all it does is it will incorporate that investment. It calls it investment in associates at cost, at the cost price, and it's simply credit bank. in his own separate financial statement. But if it's a company that has, or a parent that has subsidiaries, which means that it will prepare consolidated financial statements. And if it's not applying the exemption from consolidated financial statement, then in that case, it would prepare consolidated financial statement. So in the consolidated financial statement, the parent will account for the investments in associates using equity method. And what does the equity method say? Under the equity method, the parent will recognize the cost of investment and will increase it yearly with its share in the post-acquisition profit or retained earnings of the associates, and decrease it with any impairment losses, if there are impairment losses. And this is demonstrated below. We call it the carrying amount of investments in associates. So we'll have cost of investment, you had share of post-acquisition profits of associates, less any dividend received. Okay, by the time you deduct this from the dividend you received, that's as good as you are getting a share of retained earnings, because that's what you're supposed to get a share of. So we usually deduct any dividend received from the associates. And also, if there are, let me put it here, from associates. And also, if there are impairment losses, you deduct it. Then this will give you the carrying amounts of your investments in associates. The truth is that The above amount is the only item that is included the above amount and any other interest, any other interest in the associates, because we never can tell. You might give loan to the associates, you might have something, any other asset you have. So this plus any other interest. So let me not say, is this a loan? So the above amount and any other interest in the associates are the only items that are included in respect of the associates in the consolidated financial statement. This clearly shows that you don't combine items together like we do under the consolidation method for investments in subsidiary. So this is different for investment in subsidiary, where you will be adding items together and canceling out similar items. Here is not like that. Here you are not combining items together. Here you only include your investments in associates in consolidated financial statement. In the consolidated financial statement. I repeat again, in the consolidated financial statement. You only include this item there. And if there are any other interest you have in the associates, you also include it. It's quite straightforward. Can you hear me now?
Loud and clear, sir.
Yes, sir. Yes, sir.
I hear you.
Okay. So we don't combine items together like we do in consolidated financial statement. However, or additionally, in the consolidated statement of profit or loss, the parent also includes a one-line item in respect of its investments in associates as share of post-acquisition profit of associates. So that in fact, that's like the second leg of this. This your share of associate profits that you add to the second leg is going to P&L. They will always be the same. This one and the one that goes to P&L. Well, not every time anyway. It depends, because this one would show share of post acquisition, but let me write this as share of post acquisition profit for the year. Profit for the year. Since P&L is per year, the profit for the year of the associate. So one thing most students would find confusing is this when it comes to this investment in associates, which is why I've made it very clear. You need to understand that when an investor invests, the investor is a company on his own. So he will do a separate financial statement. He will have his own financial statement. So in his own financial statements, he doesn't do all of this. He doesn't do all of this equity method. All he does is just to recognize the investment at costs. He doesn't add share of profit and all of that. All he does is just to recognize that investment at cost, or using IFRS 9. That's all he does in his own separate financial statement. Where equity method applies is if he is preparing consolidated financial. That means if he is not preparing consolidated financial statements, this equity method will not apply. That means he will not be doing equity method. So an equity method is that you'll be taking your share of the post-acquisition profit of that subsidiary. And if there are dividend you receive from it, you cancel that out, because that's like intra-group transactions, right? So because you see this, why we are removing it from here, is that this dividend would also show, let me note it, the investor will also recognize any dividend received from the associates in each separate statement of profit or loss. So he also recognizes dividend received. So we don't consolidate that. We remove that. And if there's any impairment, you remove it. And this shows as the only item that comes in the consolidated statement of financial position. Let me be specific. And if he has any other interests, any other assets, any other thing he has in the associate, he also includes that as well. In addition to this investment in associates, if he has any other interest, he includes it. And that's the only thing he includes in the consolidated statement of financial position. So you don't consolidate, you don't combine items together like we do under investment in subsidiary. And also, in the statement of profit or loss, in the consolidated statement of profit or loss, the parent also includes just one line item in respect of investment in associates as share of post-acquisition profit for the year in the associate or for the associate. And that is all included in the statement of profit or loss. So let me take questions before I go to where there are intergroup transactions between the parent and the associate. Any questions? Any questions? Like you learned under consolidation method, the same thing applies here in that any income or expenses arising from intra-group transactions between the parents and the associates are not included in the consolidated statement of profit or loss. Additionally, if the trading between the entities results in intra-group profits, it will be eliminated to the extent of the parent's holding in the associates. I hope you understand, to the extent of the parent holding in the associate. So if they consummate transaction between one another and there is a profit of 15 naira, so you're not going to eliminate the whole of that 15 naira. You will only eliminate to the extent of the parent holding in the associate. So if the parent has only 20% in the associate, so you are going to eliminate just 20% of that profit to the extent, because here we're not consolidating, we are only taking a share of profit. And the share of profit we are taking is only to the extent of our holding. So you only eliminate intra-group profits to the extent of our holding in that associate. Note that there is no need to cancel out items, similar items of assets and liabilities arising from intra-group trading, because the entities are not consolidated. In fact, any assets, the parent, any other asset the parent has in the associates should be included in the investment in associates. So what I'm saying is this: remember that we said we usually cancel out, maybe there is receivables, there is payables under investment in subsidiary, that there are similar items. We usually cancel it out. Here it's not necessary, because it's not like you are consolidating. So the issue of canceling out similar asset and liabilities does not arise here. You are not consolidating. So in fact, if the parent has any other assets in the associate, he will include it as part of his investment in associate. He will include it there. And that was what I meant by any other interest here, when I wrote the above amount and any other interests. So it doesn't, since we don't cancel out that. So the only intra-group trading that we cancel out here are just income and expenses. You won't include that, because since you'll be taking a share of his profits, make sure that is removed. Make sure, and which is why we are removing dividend received. Okay, since we are taking a share. So, and also any profit they made from one another, you would also remove that because it will look as if you are taking a share of profit you have made from yourself, something like that. Those are the only items that we consolidate. Now, do you know that if you think of it, when you have share of profits, is it possible to have share of losses? Because we are saying share of profits. With the way this is, that means you can also have share of loss. If the associate makes loss, you will also take a share of the loss. The downside of that is that it decreases your investment. So what happens if your share of loss is now turning your investment to negative? Are you now going to have a negative investment in the consolidated financial statement? Are you now going to have a negative investment? There's nothing like negative assets in IFRS. It's either you have assets or liability. So, and when your share of losses turns your investment into negative, that means you will not you will just leave it, you exclude it at the point is zero. There's no point putting it again because you cannot have negative. It becomes an obligation. It becomes a liability. And in this case now, it's not like you have any obligation. So you don't have obligation. So you cannot recognize the liability except if the associate has made a loss to the extent that you are now also required to pay some money to some people and all of that. At that point, you have an obligation. But if any of that is not present, so as soon as your investment becomes zero, then that means you don't have asset anymore. Just exclude it. We can never have negative investment. I hope you can hear me. I just hope so. So share of associate losses, that's what I've just explained. I need you to note this. It's something that, so where the associate is a loss-making entity and the investor's share of losses decreases its cost of investment to negative, the investor must exclude the investment in associates from the consolidated financial statements. So at that point, he excludes it. And that is all. That is the principle for investment in associates. Now let's start solving questions. There's something I noted when I'm teaching online students. I noticed that when some of you mistakenly unmute yourself, there's always noise in the background. I'm always wondering, are these ones coming to class or what? That is not how to learn. And that's the downside of online classes. Some of you think you are just listening to TV or television or you're watching TV. No, you're in a class. You're supposed to be in a secluded place, not where your children are sitting, not in front of television, not where people are gisting. You're not taking it serious. You're not waiting for video. That's why some of you be harassing us. Video, 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 video. So that means we put the video out for free. The video is not the thing. The class is the thing. When you interact with the lecturer, ask questions, that's the class, not the video. You want to go and sit down for 2 hours video and be watching. Everybody have access to our videos. It's not, we are not keeping it. It's free. You have to be in class. You don't know how to, a lot of you don't know how to participate in these online classes at all. I'll be hearing noises. Anyway, so let's look at this question.
Good morning, sir.
Hey, Michael.
Sir, if my investment, if an investment in associates, the associates is a loss making, then I will
Yes.
not include the investment in the books again. Now, if independent auditors come around, how will they know that I have an investment in a particular associate if I have I have removed it from my own books?
That's an intelligent question, Michael. Probably you have to make a disclosure to them because you probably would disclose it in your separate financial statement because it will be there in your separate financial statement. You know that in your separate financial statement, you don't include uh, share of profit or losses. I mentioned that very well. That all you do is
Yeah.
just recognizing the investment at cost. You don't
Eh?
include it. You see?
Voila.
See. You don't include it in, so they will always see it there. Is actually going nowhere. But in the consolidated financial statement, that is where you would exclude it, where that is becoming so much that you're making losses and all of that. Where the associate is making losses, it will really impact only on the consolidated. So when the auditor comes, they will still see it. They will still see that investment in associate in your separate. It's just there. So by the time the the auditor looks at it, you are at that point, the auditor will see it and say, what's the situation of these assessments in the books? Because it's either you're doing it at cost or fair value through P&L or fair value through CI. And those is like those investments, they usually impair. The auditor, in his own wisdom, should impair it. He himself will impair that these guys have been making losses, even in the consolidated financial statement, you have excluded it. Why? You explain. And they will help you impair it off even in your separate financial statement eventually. Yeah, I like that question. That's very practical. Okay, let's solve some questions. Or can I have any other question? Any other questions? Okay. Now, you look at this scenario, it says company A owns 30% of the equity of company B, an associate, that it acquired for 25 million and has significant influence over it. Company B is not publicly traded and there is no active market for its shares. Company A chooses to account for all its associates at cost. So how will company A account for its investments in its separate financial statements. So this one, the question I've told you clearly that this company has 30%. So that means company B is associate. So that means all it does is that in the statement of financial position, it will just put investment in associates at 25 million at costs, which is this company A. That is all it does. Another one, it says company X owns 22% of company Y, a listed entity on the Nigerian Stock Exchange that it acquired for 105 million. Company X has significant influence over company Y. Company X chooses to measure all investments in associate at fair value through profit or loss, permitted by IFRS 9 in separate FS. The fair value of the investment at the end of the year is 120 million. How should company X present the investment associate in its financial statement? Okay. Okay, please go ahead with your question.
Okay, sir. Please, can you just scroll back to the question for this solution A you just saw? Okay.
Okay.
Yes. I want I would just want clarity on this statement that was made that company B is not publicly listed, and also that's it. So how does that affect this solution you just gave?
Oh, okay. So that is why it is measured at costs. So, which is why it is measured at cost. So it cannot possibly measure that investment at fair value because the company is not traded. So it can only account for that investment at the amount it paid for that investment. That
Okay.
is, yes. Very good question. Okay. So, in line with the question you asked, you will see this one now, they said is listed on the markets. So that means we can know its share price and all of that. Even though he bought that investment for 105,000, but maybe as a result of changes in market price, share price, and all of that, he now knows that his investment is now 120 million. That's the difference. So good observation from you. So solution here, this company now, company X, in his own separate financial statement of financial position, you have investment in associates. At the end of the year, you will recognize at fair value the 120 million. This value, this 120 million here. That is what you will recognize in his books. However, since he has decided to measure it at fair value through profit or loss, you remember what I taught you in IFRS 9. That means any changes in fair value will be recognized to profit or loss. That also means that if he's measuring it at fair value through other comprehensive income, that means any changes in OCI, any changes in fair value will be recognized to OCI. So that means in the statement of profit or loss, we'll have gain on investments, or you can call it fair value surplus. And that's the difference of how much? 15. That's 15 million. That's a good investment. Yeah. So this is in the separate account. That's all it does in his own account. So let's see what it does in the consolidated financial statement. So let's look at another question. Pico, a company with subsidiaries, acquires 50,000 of the 200,000 1 ordinary shares in ECO for 120,000 on 1st January 2017. In the year to 31st December 2017, ECO earns profit after tax of 48,000, from which it pays a dividend of 12,000. How will ECO results be accounted for in the separate and consolidated account of PICO for the year ended 31st December 2017? Okay, this one wants us to do the two. Good question. If you look at this question, they didn't tell us the holding. They just said that he acquired 50 of 200. And it says that this is 1 error. You know that they can also tell us that this is 0.5. So whatever it is, then that means, but since they give us the number of shares directly, so then probably it probably will not matter. So 200,000 1 error ordinary shares. So that means Pico holding in ECO is hold on. No. Maybe it's too early. I don't know. Have you observed any similarity between the way this equity method works, the way these investments in associates works using equity method, and the way we account for NCI? Have you observed that it's the same thing? If you remember, NCI, we just do value of NCI and share of profit of as NCI share of subsidiaries profit. That's what we do for NCI. If you remember, I don't know if you have looked at it. If you look at it maybe later, you will see that in this case now, having investment in associates is like us now, we are now NCI. It's like us, we are now NCI. So it's the same, but I'm sure over time you will link it. You'll see that it's just the same. Can you help me do 50 over 200? That should be like,
25%.
25%.
that's 25%. Okay. And he paid 120K for it on January 2007. And at the end of the year, this guy was making a profit of 48 and he's paying dividend of. So that means in the separate financial statements, under statement of profit or loss, let me do financial position first. Under statement of financial position, I will have investments in associates, and I will just recognize how much I paid. I'll just recognize how much I've paid. And also in the statement of profit or loss, in my separate statement, though, I will recognize dividend received. How much dividend did I receive? Even charity was not in it, but dividend received will be in P&L. That would be 25% times what? The subsidiary paid a dividend of, the associate paid us a dividend of, paid out dividend of 12,000, but we will receive just 25% of it. That's 12 divided by 4. That's 3,000. That's 3,000. So that's in the separate financial statements. But in the consolidated financial statements, it will under statement of financial position is still investment in associates you will have. So we will need to work it out. We need to get carrying amounts of investments in associates, which will be the cost of investments, which is 120,000. I will add my share of post-acquisition profits. My share of post-acquisition profits, which is 25% times, what was this? Which is 48,000. Share of post-acquisition profit is 48,000. So 48,000 divided by 4.
That's 12,000.
That's 2,000. Then we'll deduct dividend received because he has already recognized it here. So let's remove it from here, which is 25% times, which is 3,000. So what are we looking at as investments in associates?
1129.
129 or 129?
129.
129.
129.
Okay. So we have 129,000. And in the statement of, sorry, this should be consolidated. Consolidated statement of profits or loss. You have share of post-acquisition profit for the year of associates, which is just 25% times 48,000, which is just 12,000. That is what he recognizes in the consolidated statement of. So this is workings one. So you can find this in workings one. And that's the solution to this question. So you see the way this one outlines everything I've taught you so far. That in a separate account, it just recognizes his investment at costs. That is all it does. It will be there forever like that. And in P&L, any dividend he receives, he puts it in a separate financial statement. But in the consolidated account, that is where he applies equity method. Where there is cost, you will add his share of post-acquisition profits every year. And if there is any dividend, it removes it because he will have recognized it in his individual account. So he will cancel that out. And we then put it in a consolidated statement of financial position. And in the consolidated P&L, you will get a share of profit for the year as well. And that ends it there. Question 4. Says on 4 January 2017, Pico bought 25% shareholding in ECO at a cost of 76,000 During the year to 31st December 2017, ACO made a profit before tax of 164,000 and taxation charge in the year's profit was 64,000. A dividend of 40,000 was paid out of the profit. Calculate the entries for associates, which would appear in PICO's group. Okay, this one didn't ask us to prepare any statement. They just want us to calculate the entries in PICO's group. And I know that the entries that is relevant in the consolidated account is just the carrying amount of investments in associates, which I determined by first determining my costs of investments, which is, let me just write it in full, cost of investments, which is 176,000. Then I will add share.
76, no 176, sir.
Oh, thank you. 76. Then I'll add my share of post-acquisition profits. My share of post-acquisition profits, which is 25% times. So what's the post-acquisition profits? Is actually 164,000 minus 64,000. Because what they gave me was PBT. They did not give me tax separately. So I need to, what I need is the profit after taxes. So I believe that's
25,000. 25,000.
Okay. Then I would deduct any dividend received. Which is also 25%. What's the dividend received?
40,000.
40,000.
Times 40,000.
10,000.
Then I'm looking at 10,000. So if I accumulate all this, what am I looking at?
91,000. 91,000.
91,000. Okay, so this is very similar to the last one we solved. Now let's solve a more complex one. This one says that set out below. Okay. Yeah, Sarah, continue. Ask your question.
Okay, good morning. Sorry, just before we continue, I thought I saw profits before tax. So why are we removing tax again?
Yes, we can have profit after tax.
Yeah, if
So
I have profit after tax, should we not be adding tax? Like they gave us the figure for tax separately and gave
yeah.
us profit before tax. So why are we not removing the tax inside the profit?
Oh, okay. So when they give us a profit before tax, it means the profit before deduction of tax. So generally, so taxes are usually deducted from your profit. So this, you have made a profit of 164,000. You have not paid the government. So profit is inside there.
Okay.
Yeah, so you need to pay the government 64, which is why we have to deduct it.
Okay, so we deduct it before applying the percentage.
Yes.
Sorry, sir.
Okay, boss.
We are having share of profits. When we did subsidiary and investment in subsidiary, we cancel out any profit between the parent and the subsidiary, and it's
Yeah.
only the retained earning that we share as the percentage of each audience. I don't know this profit post acquisition profit you are sharing now. Is it? I don't know. It's confusing to me. I don't know. I felt it should be profit should not be made. between, please, can you explain some? It's confusing.
Okay, no problem. So for this one, we don't consolidate, and the principles in equity method is that I would just recognize my share of profit in that associate. And really, if you look at this deeply, if you look at this very deeply, what I'm actually adding is my share of retained earnings of that associate. Share of retained, because that's why I'm removing dividend. So ultimately, what I'm adding to my investment is my share of retained earnings. My share of retained earnings. Additionally, is that if there are transactions between the parents and the subsidiary and the associate, any profits they also make there, I told you earlier that we usually don't, you cancel that out, but you cancel it out to the extent of your holding in the associates. I will solve a question for you there and you will see. So, do you get what I've mentioned first before I proceed?
I'm trying to get you.
Okay, so that's really the reality for equity method. It's different from consolidation. Even for consolidation, yes, we consolidate, right? And any unrealized profit, any profit arising from intra-group transaction, we eliminate. It's the same here. Any intra-group, any profit arising from intra-group transactions, we would have removed it. We will remove it from this share. We won't recognize any profit made from transacting between ourselves. So since you asked this, let me note it here. Let me just bring it up now. So if PICO, okay, which is the parent. So if parent sells to associates and makes a profit of 100 naira, and parent has 20% holding in associates. So the profit above should be eliminated to the extent of the parent's holding in the associates. So, and that means in this case now, the unrealized profits is simply 25% times 100, which is 25. How do we eliminate this? So this is eliminated with the entries below. You're going to deduct it from the retained earnings of the parents, and also you're going to deduct it from, who can help me here? Where are we going to deduct the second leg? Where do we usually deduct when we did subsidiary? You can help me.
We debit the retained earnings of the parent and credit the cost of investments in associates.
What's your name, sorry?
Eno.
Eno. That's brilliant. That's brilliant. Why did you choose cost of investment and not inventory? I was waiting to hear inventory. Like we did for subsidiary. Why did you go for cost of investment?
Since it's the unrealized profit.
Since it's the unrealized profit. Okay, I know. You have tried. So ordinarily, we usually deduct from inventory, but here we cannot because we don't consolidate associate. We don't. So the inventory of the associate would not reflect in the consolidated account. So we cannot possibly deduct from inventory. So this will not work. So the only item that we can deduct from is just our investments in associates, because that one will show in the consolidated account. And that's how this works. Okay, so Tony, you can go ahead with your question, please. Tony.
Okay, I don't know that I wrote my
Oh,
percentage holding is 20% and not 25%.
Sure.
Thank you.
So let me change it to 25%. So another example, let's say it was the associate sells to parents and makes a profit of how much? 100. And parent has 25% holding in associates. So again, the profit above should be eliminated to the extent of the parent holding in the associate. So in this case, unrealized profit is 25. So how do we eliminate this? How do we eliminate it? So we will deduct it from where now? Deduct from, where do we deduct it from?
I would say the retained earnings of the parent.
No, it's not the parents making profit.
Okay.
I think from the associate. I think from the profit of the associate.
The investment of associates, because that's the only account that will show in the consolidated statement.
Oh, will not credit. Oh, what will not be the other leg?
It will now be the inventory. We now deduct from inventory, sir.
Why is it not going to inventory this time around?
Because the associate sold inventory to the parents.
Because it sold inventory to the parents. So, and since we are going to consolidate the inventory, so we can come in. Okay, good enough. You guys tried. So retain earnings first. In this case, we will deduct it from the retained earnings of the associates. So the person that said investment in associates is not bad. You have not gotten it wrong, but let's just deduct it at source before we take our share in the associates' profits. Okay, so we know that whenever we are now taking our share in profits, we know we have already deducted the unrealized profit. So don't wait until investment in associates before you start removing any unrealized profits. And like Michael said, you deduct from the inventory of the parent. Since it's the parent that bought the goods now, that means the inventory is in the books of the parents. So we can easily deduct from here. Okay. So the reason why inventory is not coming up here at all is that inventory is in the books of the associates, and we are not consolidating the associates. That's why the only one we could hold responsible is this. So either ways, the unrealized profit is going out at the level of investment in associates. So that we will not be taking a share of unrealized profit. So it's gone. Also, here, since the associate we are going to take his share of profit out or eventually, and now he has made a profit from intra-group transactions, so we eliminate it from that profit first before we take our share. Then we can easily deduct from inventory. So you see, was it Tony or who asked? I think it was Bosse. So that share of profit you are seeing in investment in associates is a share of profit after removing any unrealized profit. Is after removing any intra-group profit. So it's not included. We're not taking share of profits between the two of them. Okay. Now let's come back to this question.
Okay, sir.
Yeah. It says, the set out below are the accounts of parent co and its subsidiaries and of associate co. Parent co acquires 40% of the equity capital of associate co 5 years ago, when the latter reserves stood at 20,000. So we're given the financial position of the parent and its subsidiaries and that of the associate. We're also given statement of financial position of profit or loss of the parent and subsidiaries and the associate. We're now required to prepare consolidated accounts of parent co. Okay. So the point here, I can see that I have 40% holding in the associate, and I bought it 5 years ago. And I bought it when he only had a reserve of 20. Now my guy has a reserve of 50. Good, he has done well for himself. He has made additional 30,000 profits. Not bad. So let's consolidate. When it comes to associates and you want to consolidate, two things you need to ask yourself. Are there any intra-group transactions? And how do I sort out my investment in associates? That is my carrying amount of investment in associates. Those are the two things you would always need to resolve. Now that they have given us our holding. So I want to resolve that. Let me quickly get that done. My carrying amount of investment in associates. I start with my cost of investment. And what's my cost of investment? It's 30,000. Let me use the same level of rounding up. 30? Yes, yes. I'm with you, Charity. Ask a question before I proceed. Okay, I thought you wanted to ask a question. Sure.
Sir, can you hear me?
Yes, I can hear you now.
Okay. Sir, the question is in exam situation, like when we get into that exam hall and
Okay.
with all the whole tension, we're about to start solving group consolidated question. Do I have to start with workings first, or I should start with the financial position, consolidate the ones that does not have additional information, then now go back to my workings? Or I should start with the workings and then be doing the consolidation interchangeably? Because the time is limited. I just saw this question now that we're about to start solving, and I'm now like in an exam situation. What should I do first?
Yeah, good question from you, Charity. I like the fact that you're proactive, you're thinking ahead. So yeah, it's good to be smart with your exams because the first thing in the exam is to pass. Then you can be showing skills later when in practice. But um, you do your workings first before your solution. That's why you'd that's why the time is there to time yourself and proceed with the right thing to that approach of going through adding together and all of that without considering the workings and all of that is somebody that is not well prepared and just wants to smart his way out and all of that. And it could be very detrimental in some cases. And that means before you even know the ones that will not require workings, that means you will have even carefully read through the whole question before you even identify that. So it's just better you use that effort to start your workings. It doesn't take so much time. So we're still going to solve past questions. I will teach you all of these things. That's what um October is meant for. So I'll still show you how to manage your time and all of that. At least for your question one, you have roughly 50 minutes. So if you know what you're doing, you should finish that question in 50 minutes. So we are going to teach you time management so that in the exam you will know that if you have read, you will know that you have time because you know how long you need to spend on every question. So the issue of I don't have time is not there. You have time. The question is structured in a way that the time should be enough for you to answer all the questions you need to answer, except if you don't know what you're doing and you're just writing irrelevancies. So that 50 minutes is enough for somebody that has gone through our class, revised, to structure your workings. And if there's any information you don't know how to work out, say leave it. Go to the one you know. Adjust the one you can adjust. Prepare your account. But don't spend beyond the time that will be allocated for it. So you see, these are discussions that I'll be having with you from third week in October, teaching you time management, how to structure and make sure you do all the questions in the exam and pass. So all these will come up at those points in time. So, but for now, let's do the needful. Let's cover the syllabus and be ready. So, good questions from good question from you. Okay, so moving on. Our share of profits, we have 40% holding in the associates. And what's the profit of the associates? Now, you see, when you go to P&L of the associates, the profit of the associate is actually 25. If you use 25 here, You will be wrong because this is the profit for the year of the associate. What you need to add here is the profits, is your share of the profits of the associate that the associate has made from when you acquire that investment. That's what you need to add here, not just profit for the year. Not that profit of the year will not be included though, but the profit the associate has made, okay, subsequent to when you acquired the investment. So looking at this question, who can tell me the profits, the post-acquisition profit of the associate?
The post-acquisition profit is 20,000, sir.
How did you get that?
That's the retained earning before the acquisition, sir. 20,000.
So the
No,
post is 30.
thank you,
The
Eno. Thank you, Eno. So the post is 30. Michael, this is the pre-acquisition profit, which is the reserve for the profit of the associate when we acquired him, meaning that is the profit he has made before we acquired him. So that's pre. The retained earnings of the associate is 50, which is the cumulative profit he has made since he started. So when you take away this 20 that he has made before we acquired him, that means the post is 30. You know, you're intelligent. I've always known that.
Thank you, sir.
So 50 minus 20. So what's 40% of 30? What would that give us? It should be 12, I guess. 12. Then this gives me, I want to have it here. Carrying amount of investment is 42. So this 42. Then, having determined that, I can go ahead and consolidate. So PICO, consolidated statement of financial position. First, I have tangible non-current assets. How much will I consolidate?
110.
Thank you very much. You do not consolidate this 85. You don't consolidate this 85 because you're using equity method. So only this 110 will come in. So this is 110. This investment in associates that was 30, we consolidate that, but it has now become 42 because we have taken our share of post-acquisition profit. So investment in associates is 42. Then we give a loan to associates of 10, and there's a corresponding 10 in the books of associates. Are we going to cancel out this? No. I already told you that there is no need to cancel out assets and liabilities because we don't consolidate. In fact, you would actually consolidate any other assets, any other interests that the parent has in the associates. You consolidate it. So we're actually going to consolidate this loan to associates. It will be incorporated in a consolidated account, loan to associates of how much? Of 30. Of 30. And what was the next item? We have current assets. Again, we won't consolidate this. We only have 50.
So the loan is 10.
Oh, okay. Thank you. 10. Current assets. 50. And that's it for that end. So what's the addition of all this? My total assets?
212. 212.
212. Equity and liabilities. Equity. I have my ordinary share capital. What's my ordinary share capital? I have 125. I have 125. Then my consolidated retained earnings. What's my consolidated retained earnings? I think it's better we do the workings for this, even though it's straightforward. So consolidated retained earnings of PICO and ACO. As per the question, what's the retained earnings of parent and subsidiary? 75. This guy is 50. 75, 50. You remove pre-acquisition retained earnings, which is 20. Then we are left with a post of 30. And the group share is 40% times 30, which is 12. Then it's going to have how much? 87. You will have 87. So the parent has 87. And what's the next item after that? That's all. So what's the addition of these two?
212.
212. Then consolidated statement of profit or loss for the year ended the relevant dates. They give us PBT, profit before tax. We're only taking 47.5. Then our income tax, how much is it? We have 17.5. Leaving us to profit after tax of 30. And we'll get share of associate profit for the year, which is 40% times the profit for the year of associates, which is 25. So we multiply this by 25. What does that give us?
10.
10. So Our profit for the year is now 40. Well, that's the end of this question. So see the way we methodically and systematically resolved it step by step. Consolidate, ensuring that we are not consolidating what we should not consolidate. We don't add figures of associates together. All we did was just to include investment in associates at the carrying amount. And when we are doing our consolidated retained earnings, we took also our share of his own retained earnings to add it to that of the parent. And in my P&L, I only did a one-line item to take share of the associate profit for the year. Share of associate profit for the year. Do you have any question before I move to the next question?
And not a question actually. I can this one is just like we preparing our non-controlling interests separately for I'm trying to relate it with the investment in subsidiary and the way we are doing our non-controlling.
Exactly. It's just the same thing. It's actually the same thing. Just that you see that because it's the same treatment. Just that it's like we are now NCI. Now in our own books now is an investment. The guys that are the guys that have 60%, that have 60% holding, this same amount, you see them putting it in equity, just like we did when we were doing subsidiary, since we were the one that had control then also. And also they will also put NCI as part of, I mean, this is like we are treating NCI. That's the same. That's what we call NCI really. Okay. Now, I think I've already resolved this when Bosse asked the question, but let's just look at it. It says Pico holds 25% of the equity of ECO. During the year, Pico makes sales of 500,000 to ECO at a cost plus a 25% markup. At the end, ECO has all these inventory, all these goods still in inventory. I'm sure they want us to determine the unrealized profits to eliminate. So here now, the unrealized profits is the intragroup profit is 25. Is it going to be over 100 or over 100 plus 25? Which of it?
It should be 105.
No, it's 25 over 100 because it's already on cost
25
plus and it's markup.
It's markup now.
Well, let's take it one by one. Femi, let me hear you.
I said it's 25 over 100 because it's on cost plus and it's already markup, so it's on cost. So it's going to be
Okay.
25 over 100.
Okay. Yeah, Bossa, you can talk now.
Yeah, I felt it should be 25 over 105.
Where
That
did you see 105?
is markup. I felt it should go back to
125, not 105.
Okay, you mean 125.
sorry, 125, sorry.
Okay.
I felt this is markup. We should make it margin, Abby. I don't know.
Any other person? I don't know what I want, what I would do so that you understand this thing perfectly. So that you would understand this thing perfectly. So Pico makes sales of 500,000 to Echo at cost plus markup. This is already including profits. It's inclusive of profits. So that means this is the selling price. So it should be plus 25. If you want to eliminate the profit inside, you cannot do 25 over 100 again. This is not at 100. This is at 125. It's inclusive of, this is the selling price. It's really where the examiner gives you the costs. That, okay, the costs of us buying this thing is this. But when we sell, we sell at a markup of this. To now get the profit is just 25 over 100 times that cost. But since the examiner gave us that, okay, it sells at this, and this so is already marked up by 25%. So this is selling price. So for you to get the profit, you need to bring up the base also to 25. Some people call that converting markup to margin. I believe a lot of people are just cramming. They don't understand what that means really in the literal sense of it. So, but this is me. Let me take out that, okay, converting markup to margin. Understand what is happening. Beyond here, you are converting from markup to margin. Now, so what? Understand what is happening. That this is already at a profit load. It already includes the 25%. To get the profit out of it, you can't do 25 over 100. It will be 25 over 125 times 500. Okay. Okay, please ask your question. I can see your hand.
Okay, sir. I just want to confirm. So that means when we see cost plus and markup is the same thing.
Yes, yes, yes.
Okay, sir.
Okay, so can you give me the figure, please?
100,000.
So what we eliminate as unrealized profits here is not the whole of the 100,000. It's just 25% off. You only eliminate to the extent of our holding, which is 25,000 here. So what will be the double entry to eliminate? Can't tell me. We'll deduct from where?
Retained earnings.
Okay, 10 earnings of Pico, because Pico that is making the profit. And we also deduct from where?
Inventory. Inventory of
Cost of the
association.
investment.
Investment in associate.
That's correct. Because we sold to Echo, so the inventory is with Echo. So, and we don't consolidate Echo, so we cannot possibly deduct from inventory because we don't consolidate Echo. So the only candidate for deduction is investment in associates. Those are investments in associates. Okay. Let's solve one more question, then we'll be done on this. They gave us statement of financial position of Pico and his investee companies, ESCO and JECO, at 31st December 2017, as shown below. So they give us Pico, ESCO, and JECO. Okay, Charity, please, can you ask a question? I need you to talk.
To be sincere, you see that intra-group transaction part, it still gets me off balance. Like, because usually I used to do everything on inventory, and now I have to learn that it's no longer inventory, it's now investment in associate. So please, can you explain it like very well again, that in a way that I can understand it?
Okay. So what you know still applies for subsidiary, and it also still applies to associate as well. If it is the associate that sold, so if the associate sold to the parent, that means it's the parent that has the goods, that has profit in it. It's the parent that has that good, that has profit in it. And you know that we will need to remove or eliminate that profit when we want to consolidate. So in that wise, we can easily deduct that unrealized profit from inventory as well as from the retained earnings. So what you know still applies there. If the inventory is with us, the parent, and that will only apply where it is the associate that sold. The only situation where that will not fly, which is the only situation, is where the parent sold to associate, which means that the inventory is with the associate. And considering the fact that we do not consolidate the associate, we cannot possibly remove that profit load from inventory anymore, because the inventory we are supposed to remove we don't include it in the consolidated account, right? Yes, we deduct from profits. That one still flies because it's the parent that is making profit, is the one that sold. But the other leg, which is inventory now, we don't consolidate it. We have sold it to the associate. We don't consolidate. So we cannot deduct inventory. That would be wrong. If you deduct inventory, I mean, you are deducting inventory of the parent, and there's no profit loading in that. That transaction, the inventory, is with the associate. So the only item representing the associate in our books, in the consolidated account, is the investment in associate. And that is why we are deducting investment in associate. So what you know still applies to all the other ones except this, where the inventory is not within us anymore, where we have sold it out to an associate, and the profit load is with that inventory, is with that associate. So while we deduct earnings of the parent that sold, that made the profit, we can only deduct the other leg from investment in associate, not inventory. Inventory is nowhere to be found. It's with the associates, and we don't consolidate that item. I hope that helps.
Yes, thank you so much.
You're welcome. Okay, so back to this. We have three entities, Pico, Esco, Jeco. Let's see who they are. So since Pico acquired 1.2 million shares in Esco on 4th January 2010 for 2 million, when the retained earnings of Esco is 400. Okay, I can see that this one is probably a subsidiary, because if I do 1/2, okay, the nominal value of the shares is 1 euro, so it's still 2 million shares. I should be getting to almost 60%. We check. Also, at the date of acquisition of Esco, the fair value of the freehold property was considered to be 800,000 greater than its value in Esco. Statement of financial position. The building element comprising of 50% of total value has remaining useful life of 50 years. Okay. I've taught you this adjustment severally. This is where we have a fair value, a revaluation surplus at the date of acquisition, where the subsidiary revalued its assets and is having a surplus. And I taught you that it becomes a pre-acquisition surplus and we would also increase the value of that asset by that amount. And there would be depreciation we have not charged so far that needs to be charged. Okay, we'll look at it. Also, Pico acquired 415,000 shares in JCO for 1 million, and the retained earnings is 300. So, who is JCO? If I look at this 450, how many shares does JCO has? Oh, okay. JCO will be an associate. We'll confirm. Also, ESCO manufactures a company used by both JCO and ESCO and PICO. And ESCO sells this component at cost plus 25%. Anytime you see cost plus 25%, this 25% is markup. PICO held 200,000 inventory of this component at 34 December 2017. In the same period, PICO sold goods to JCO, of which JCO had 160,000 in inventory. At 34 December 2017, PICO had marked up this good by 25. Okay, these intragroup transactions, which we are going to get the unrealized profits, which we are going to eliminate. Also, the goodwill in ESCO is impaired and should be fully written off. An impairment loss of 1 in 4,000 is to be recognized on investment in JCO. Okay, interesting. NCI is valued at full fair value, and ESCO shares were trading at 160 kobo prior to the acquisition of JCO. Prepare consolidated financial statement. I feel it to be fair to you if I give you this as assignment. I just feel it's just really fair to you for me to do that.
No,
Yes, so let's attempt it.
no, sir.
All
This
right.
question is loaded. Is loaded.
Sir,
Let's
please,
attempt it.
this
If we can't
question
solve it,
has
you will
a
not
lot
solve it
in
for us
it.
in the.
No, sir, no.
No,
Now,
Allah.
I
Let's
feel we
solve it
can try,
now.
Who is
then we'll come back
laughing?
and do the solution.
No, sir, no. You leave the group. Leave. Come back and watch the video and see if you got it right.
You can remove
Ah.
me from the group. Oh.
It's okay, it's okay, it's okay, it's okay. All right, so no, Allah. I will solve it, I will solve it. But even by our timing, we agreed we're going to close by 10. And I'm sure some of you already have plans for 10. So it will not be fair for me to start doing anything beyond this time. I'll be wasting my time, right? So I will do
Exactly.
it for you. So while I would do it, you can also try it. And the question is not, there's nothing special in this question. Yes, they have a lot of stories, but it's so straightforward. There's nothing there. There's really nothing. I would appreciate if you can attempt it yourself.
I'll be here. You don't have anybody that wants to leave should leave. Me, I'll be here with you, be solving it.
I know you'll be here with me. I know you'll be here with me, but
Yes.
don't worry. Okay, I will
Sir,
solve.
if we don't start attempting question like this,
Hmm.
you are spoon feeding us. Oh.
I
It's
know.
here,
So if we
don't worry about us.
Sir, hello, sir.
Femi,
Sir, hello, sir.
they say you should not worry about them also.
Okay,
Yeah,
sir,
so,
can I suggest something? Okay,
yes,
so
Samuel.
I think few of these might be where the issues are. I think from the first additional information is clear. It's 60-30 in terms of what we're looking at. Associate is 30% and for the subsidiary is 60%. So that's clear. So I think
Yes.
I think where there might be, probably we can just discuss the adjustments, then we can solve later on our own because consolidation is not the issue. And so I think if we just understand few of, I think where the concern might be is D and B. If you speak to D and B again, I think that will make sense. We
Okay.
can all attempt it after that. I think that's straightforward. Every other thing is good. It's easy to assess.
Yeah, I agree with you, Samuel. Thank you for that.
Hello, sir. Hello,
Yes,
sir.
Michael. Yeah, Michael.
Yes, I even want to ask, I even want to ask, sir, when will these classes end, sir? Because we are taking all the courses. Some of us
Yes.
are taking all the five, and we are also working. And I
Yeah.
traveled throughout last month. I came,
Mm-hmm.
so I have not been in class, so I need the time that I can also do revision on my own, and if I have any question, I can call you, sir. So I even want to know which period did this class end, sir.
Third week in October for me. Third week in October. So for the two of you, what I have left is just after group is ratio, EPS, cash flow, sustainability reporting.
Okay,
So that's
sir.
what I
Please,
remain.
please, please, sir. I would like this question to be an assignment, because if we cannot try it now, it's less than 2 months. Oh.
Why?
It's a month, not even 2 months. A month.
Let them solve it.
Okay.
Because we'll still do our revision on ourselves by ourselves now. Let's just do it.
Okay.
Let us
All
not.
right. So
Okay,
I
let's
so
attempt. Then Mr. Asu will come back at our next class. He will solve it for us. So we're able to know
yes.
where we've done wrong.
Yes, let us
Okay.
start doing something like this.
Okay. So yes, you would do it. So
Okay,
let me
sir.
just yeah.
Okay,
Okay.
sir.
Okay. Yeah. Please.
Sir, please, I'm of the opinion that that Sunday class should continue. We can still continue it, still using it for our.
Okay. So that we can finish on time, Abby. Yes. Okay. Is there any other person still talking?
Is the network? Is the network? Please, I'm
Hello,
of the
sir.
opinion that that Sunday class should continue so that we can.
Hello? Hello?
Okay, I get your message, Tony. Okay, I get your message. So we will discuss that. We'll discuss that. So, there are some people like Mr. Christopher. Mr. Christopher is a pastor in church. He would not want to miss churches for few weeks. So, and I don't want to make Mr. Christopher angry. So, yeah, I can see your hand, Wumi. You can ask a question.
Okay, sir. Network has been dealing with me since morning. So I want to know, are we still meeting later tonight, or this is just for today?
We'll meet though. We'll
Okay,
meet.
that's fine.
We'll meet tonight.
Everybody?
No, 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 not everybody. Oh, that's true. Wait, let everybody meet now. Everybody can meet
Yes.
now, so that we can do.
This
So that we
solution.
can, yes, so that we can even
Yes,
solve the
let's attempt
question.
it this morning.
Yes, you can attempt it, then we'll solve it this evening. Then we'll
Sir,
do profit or loss as well.
sir, if you ask us to attempt it this morning, I'm going to work, and the time I took is from 8 to 10. So I don't know if I will be staying extra hour. Do you
Yeah,
understand, sir? So I may not,
you
sir,
cannot
but
be
I'll
able
try.
to. Okay, no wala now. Just try your best, okay? And see if you can do it. Okay. So Samuel, I agree with your idea. So since there's an opening for us this evening, I think we should attempt it. Then we solve it this evening. Then we'll do P&L as well this evening. Then we know that we are done for the guys at skills level. We know that you guys are done with group accounts. As soon as we are done with P&Ls, you guys can move to cash flow ratios and EPS and all of that. But for you
Oh,
guys, professional, you guys are just starting. You still have like 3 or 4 classes before we finish up group accounts for you guys. Okay,
Sir, but
so
what time in the evening? Sorry, sir.
mm, we can do our normal timing now. We can
Nine,
do
nine. Are you not nine?
we can
eight
do that.
thirty, eight
Yes.
thirty
8:30.
to
8:30,
11.
sorry.
Yes.
Sir,
We
can
can
we
do
bring
people
it
are
forward?
offering.
Can we bring it like 8 to 10 or 7 to 9?
Yeah, so that we can round up and go to bed, and anybody that wants to read afterwards, we continue.
Please, that eight
I
that
thought
eight
we
is
Or
have
maybe
okay.
tomorrow.
tax
There's
This
no
by
7
That
to
eight is
9,
okay.
Oh no, our class starts 8 to 11.
this
Yeah.
7 to 9 you are bringing is not our time now. Shebi is
It's
8:30 to
Yes,
11.
it's
That is our time.
don't mind them. They want to sleep. FR people.
please 8:30 is okay, sir.
Yeah, it's fine. All right. It's all good. So I'll see you guys later in the evening. Try to solve it. I know that 90% of you will not, but it's okay. I'll see you in the evening. Bye.
Please
Thank you,
share the
sir.
working notes. Thank
I'll
you.
do that. I'll do that immediately. Bye bye.